Hi, I'm Lauren, and on the first birthday of the VT Chelsea Managed Funds, I'm joined by Darius, James and Ryan to recap over the last 12 months. What were the key market themes in the first year for the funds?
The most important starting point in the funds is valuations. What price are equities versus other asset classes, and then the underlying geographies within them. The major driving theme, as in most years, is politics, whether around the world. Clearly we've had Trump and North Korea, but we've also had Italy and Spain having change of governments and or elections, and continued worries about Brexit in the UK and its eventual outcome.
So in December, we had Trump's tax cuts which came through, and that led to a very positive start at the beginning of the new year. Markets started to see the first signs of euphoria, but then volatility came back in a very big way as people started suddenly get worried about inflation, and we saw a big sell-off at the start of February. And this really gave a good opportunity for the fund to add to some of its holdings at much cheaper prices.
Trade wars as well affected market sentiment at the beginning of the year. This has subsided since, which is strange as now the trade wars are actually coming into effect. So we don't believe that the markets are currently pricing the risk of this.
Which asset allocation decision was best in hindsight, and which was the worst?
Two of the most important decisions the funds have made this year was firstly being underweight fixed income. In an inflationary environment where rate rises, fixed income tends to be a poorly performing asset class. And given the starting yield on the majority of the asset class was already low, the funds felt it was most appropriate to have very little in fixed income. From an equity point of view, the majority of the funds have been overweight Asia and emerging markets. And actually that has been a really good result for the funds in the first year.
One area the funds could have done better was our allocation to smaller companies. Smaller companies have performed very strongly this year, both in the UK and the US. There is some weight in the funds to that, but it could certainly have been higher.
The specialist infrastructure plays have been very useful for the funds. They hold a variety in healthcare, infrastructure, renewable energy, and having these solid defensive income-paying strategies has really helped the performance of the funds.
Can you give examples of a couple of underlying funds that have done particularly well over the last year?
Yeah, the funds have had a really good first year, and being overweight in the equity portion of the funds to Asia and emerging markets has been a real strong addition to performance. Particularly RWC, Global Emerging Markets. This fund has a up to 20% allocation to frontier markets, which are the even smaller and more developing. And to get that exposure in one fund has been a real result, and the fund has performed very well in the first 12 months.
The Man GRG holding in the monthly income fund was also very beneficial to the fund's performance. Not only is it more of a value play and therefore tapping into the bit of resurgence in value in the markets, but it's a cracking dividend player as well, and has delivered the fund an awful lot of yield for its investors.
Across three of the four funds, the best performer has been the Lindsell Train Investment Trust, which is a special situation. This trust, the real asset to this trust is the fact it invests very heavily in the Lindsell Train business itself, which is a big part of the trust, and that's been doing very well recently. The trust has historically traded as high as a 70% premium. Last year there was quite a big sell-off in that premium. It came down to as low as 10%, and that was a good opportunity for the fund to really add to it and build quite a big position. Since then we've seen that premium recover, and it's been really beneficial for performance.
What do you think the biggest influences on investment decisions will be over the next 12 months?
One of the things we've learned in this last year is actually that we all worry quite a lot. We're always looking for where the next sort of bump in the roads would be. The fund has concerns about valuations broadly across equity markets. US equities are more expensive than they were a year ago. The thing that the fund has a real close eye on is inflation. Will that lead to further and more prolific rate rises, and what that then might do to equities and bonds? Those are two of the key things that worry me.
I think the question over where we are in the cycle is very prominent. In the US, some of the indicators coming out indicate that we're getting towards the end of the cycle, and that will definitely be a concern for the funds going forward.
I think the key thing to remember with these funds is they do take a long-term view. So if some of the fund's positions are to Asian emerging markets, looking to capture the growth in that region over the next 10 to 15 years. The other things the fund's really try to do, particularly the cautious and income funds is invest in a really diverse range of different assets, and that can hopefully protect those funds in most market environments.
Darius, James, Ryan, thank you.